What if the next big market shock didn't sink your retail business, but instead became the moment you leap ahead?
In this episode, Dr. Rebecca Homkes, London Business School lecturer and author of Survive, Reset, Thrive, walks us through a real comeback story and breaks down her Survival, Reset, Thrive playbook so you can stabilize fast, reset strategy smartly, and execute to grow in 2026.
We'll unpack the macro signals shaping consumer behavior, what rising rates and tariffs mean for margins and inventory, and the must-win battles that separate winners from laggards, and an AI-first checklist you can use right away.
So stay with us to hear exactly what moves to make this year so you can achieve the growth you want under even the most uncertain conditions.
Let's get into it.
You're listening to the Retail Razor Show, where your expert hosts and their guests cut through the clutter in retail and retail tech.
Welcome to the Retail Razor Show, a top 15 retail management and top 10 retail marketing podcast on Apple Podcasts, and the only retail podcast in the top 10 all-time indie management charts on Good Pods. I'm Ricardo Belmar.
And I'm Casey Golden. Welcome back, Retail Razor fans, to retail's favorite podcast, where we cut through the clutter to give you sharp insights on what's happening in retail today, tomorrow, and where we get real about what's driving the future of commerce.
Today's episode is something you haven't seen from us before. We're diving into new territory because you can't really develop a strong strategy for growth just by understanding the trends without really analyzing what's happening throughout the economy, what risks government policy changes could bring, and without a look at how consumers are reacting to all that financial uncertainty. Well, you really need a capable guide to help you navigate all of that, don't you? Otherwise, how can you create a growth strategy for the year?
That's right. So today we're joined by someone whose specialty is analyzing all of those difficult, both tangible and intangible criteria to help you shape your strategy for the year. We're talking to someone who brings both an academic viewpoint and a management consultant's sharp point of view to the situation.
We're joined today by Dr. Rebecca Homkes, a high-growth strategy specialist and the founder of a boutique consultancy firm, GrowthX, advising CEOs and executive teams focused on growth and success through uncertainty. She's part of the faculty at Duke Corporate Executive Education, a lecturer at the London Business School Executive Education, advisor and faculty at BCGU, the Boston Consulting Group University, and a previous fellow at the London School of Economics Center for Economic Performance.
Rebecca is also a global keynote speaker and the author of the book Survive, Reset, Thrive, Leading Breakthrough Growth Strategy in Volatile Times, a practical playbook for leading growth through uncertainty.
Rebecca developed the Survive, Reset, Thrive, or SRT approach to creating and leading growth strategy through uncertainty. Her SRT loop, which we'll learn about in detail, helps leaders stabilize during market shocks, reset strategy when the market changes, and then execute to thrive. We'll talk about what that means for retail in 2026, from consumer behavior and store strategy to interest rate risk, tariffs, and where AI can actually move the needle.
And spoiler alert, later in the episode, Rebecca will share a checklist for retailers facing a hard reset, named the must-win battles she expects will define retail winners in 2026, and give you all the tools you need to thrive in the most of uncertain conditions.
But before we dive in, a quick favor. If you're enjoying the show, hit us with a 5-star rating or like and drop a short review on Apple Podcasts, Spotify, Good Pods, YouTube, or wherever you're listening and watching.
Plus, check out the other shows in the Retail Razor Podcast Network, Retail Transformers, Blade to Greatness, and Data Blades. You'll find them in your favorite podcast app or together on our YouTube channel.
Now let's get into it. Here's our deep dive into the uncertainty and realities of 2026 with Dr. Rebecca Homkes, whom I have no doubt will quickly be a fan favorite on the show. Rebecca, welcome to the Retail Razor Show. We are so excited to talk with you and learn from you and get your guidance on our retailers and really prepare for this year while, once again, it seems expecting more uncertainty this year, changing economic conditions, and a very cautious consumer.
Absolutely. Thank you so much for having me.
Yeah, it's really wonderful to have you on the show. It's not often that we have the opportunity to learn from someone who really understands how to create growth out of all of this uncertainty and deliver strong execution.
And I guess we could say you wear quite a few hats, so to speak, right? Ranging from economist, London Business School lecturer, Duke faculty, you're the author of the book, Survive, Reset, Thrive, which I know we'll get to learn more about. But for listeners who haven't had the opportunity to meet your work yet, can you give us a quick kind of background on what your various roles are? Kind of explain that Survive, Reset, Thrive loop that I know we'll get into more details on from your book and how that grew out of your experience advising companies.
Yeah, absolutely. So I'm based across London, Miami, and San Francisco, and I'm a faculty member at the London Business School and Duke. But in both of them, I just work in our executive program, so working with companies. Because I spend the majority of my time working directly with CEOs and executive teams who are looking to grow. And so my specialty is high growth strategy. That's developing strategy, executing on strategy, and innovating on strategy, which of course now includes incorporating AI into your value creation story. And I've been doing this for a very long time. And where kind of the Survive, Reset, Thrive mode came out of was a little bit after Brexit, which happened in the UK in 2016, but really hit home after COVID in 2020, was speaking to so many executives across all industries, but a lot of retail and consumer goods. And I found that whenever we had a big shock to the system, the constant thing I would get from CEOs and executives is this: why me? Why now? Like, why is this happening to me? I had a plan. Everything was working. And realization one was you can't call yourself an entrepreneurial leader if you can't grow in any market, right? We don't let the market tell us when it's a good time to grow. And second, growth is a loop, not a line, which sounds really theoretical, but to make it practical, we have, frankly, unfortunately, raised leaders and organizations with linear planning, like checklist and the 10-point checklist, the 5-point checklist. We've almost convinced ourselves we can checklist ourselves to growth, and that's not how the world works. This is a loop, and loops are great. And you're going to go through this constant loop of survive, reset, and thrive. There's going to be shocks to the system. You've got to stabilize, but then you need to reset to change for the new world. Then you can go back to being a thriving organization. But even when you're doing everything right and thrive, there's going to be other shocks, and embracing the loop allows you to lead your organization through different parts of the journey and not always assume it's about getting back on track.
It's a great mindset shift, actually.
Yeah.
So you've worked with many leading retail and consumer brands and companies and advised executive teams through these unexpected market shocks without naming names, of course. What's a short example of a company that used SRT to turn a disruption into a growth opportunity?
Yeah, well, I'm really fortunate to work with a lot of great brands. So I work with companies like WD-40 and Gorilla Glue. I do some work with Procter & Gamble, but also brands across many other industries, a lot in the infrastructure, construction, concrete, and fashion space. WD-40 is a great example of an organization that has hit some shocks. For instance, when COVID, when their kind of retailers were closed for a bit, they had to really leverage up on e-commerce. Their user is shifting now, right? Is that their kind of typical user is aging a bit, and we've got to think about building the brand with the next generation. And of course, what AI and sustainability means. And so they really use Survive, Reset, Thrive to, one, make decisions based on beliefs, not always waiting for established facts. You've really got to take some stances on how quickly some of these key themes are going to influence your industry, and also emphasize on the learning. So they really have embraced the mode of SRT and focusing on building what we call this learning organization. And so that's, again, advancing the partnerships with their retailers, but also understanding where future growth is going to come from, which will be from emerging markets, their industrial channel, as well as embracing these key, what we call megatrends around sustainability and growth markets and digital commerce. So I think some really successful examples. There's also smaller examples, but I'll just share one of my favorites. And of course, I love every company I've worked with equally. But a really great example of Survive, Reset, Thrive was in the consumer space. And actually, one of the companies runs all the zoos and amusement parks in Scandinavia. And if you think your business got hit hard in the early 2020s, well, their business was closed by the government. So you go from 2 weeks to opening the season to every single business is closed. And the CEO was a fourth generation. And he had this really difficult moment where he said, my great-great-grandfather got this company through World War I. My grandfather got this through the Spanish War and World War II. My father got this through the inflation spikes in the 1970s. And now on my watch, the whole family business is going to go down. And they really embraced the notion that we first have to survive, that too many people in the industry were just focused on opening. And they took the opportunity to really survive. They did things like mapping out their supply network and saying, well, everyone is trying to stop paying people. They mapped the ecosystem and realized there's 2 or 3 suppliers that if they don't survive, this industry won't. And they prioritized paying them. They built really proactive relationships with the government. And so they were able to go into reset months before anyone else in the industry. And why I love this story is as they were going into reset, they realized that mentally the team was struggling to get out of that survive mentality. And we'll come back to this. We're seeing this with some retailers in the US right now. And so what they did is they split the team into 2. They made a survive team and a reset team. And they told the survive team, look, you're responsible for these critical metrics like cash and cost and customers and communication. But reset team, I need you to open your growth mindset and be prepared for where growth is coming. And they realized that asking people to do both wasn't happening. And they likened it to sports. If you think about any sport, American football or European football, you don't ask a player to play offense and defense in the same game. Yet why are we asking our teams to do both, right, on a day-to-day? And so splitting them allowed both mindsets to really focus. So they moved out of that reset into the thrive. And 2020 was their most profitable and highest growth year, despite being limited to 20 to 30% capacity. But they also had their highest levels of NPS and engagement, and they kept building on those metrics the 5 years after that. So really embracing the mode of survive, reset, thrive. I've seen such powerful examples, and that's just 2 of them.
That's a really compelling value proposition. We're seeing a lot of org charts changing and have to change now because of AI, and more organizations flatten. Very compelling.
Yeah.
When you think about it, because it's typically just all on your desk.
All on your desk. Yeah. And just and then we make that a prideful moment. And we brag about how my team is great in a crisis. And we love it when there's this urgency. And this is a top question I get asked is, how can I always have this spirit of urgency and crisis? And that's actually not what you want, right? Because that is emotionally and mentally draining. And that doesn't actually build this growth mindset we want. So frankly, we need to stop romanticizing being great in a crisis. Crises happen. We can't avoid them, but we need to acknowledge them for what they are, parts of the survive phase, so we can move on to that next aspect.
Yeah, that's a great point. Especially, in your example, when they recognized they needed to split the team into these moves, because that's something you don't hear often where a lot of leaders want to focus on getting everyone in the team involved in the same focus. And sometimes that's not the right answer, right? That's not the way to make the best use of the resources you have. So I want to shift a little and look a little bit forward into what we think may happen this year. So just looking at the bigger macro picture for 2026. At this time, right, we're recording this in February, we're already starting to hear a lot of forecasts and what people are expecting for modest GDP growth, what they're expecting around sticky inflation for parts of the year, concerns about what the Fed may or may not do around rates throughout the year. How should retail leaders really translate that picture into their immediate checklist of priorities and how they should look at the next 12 months?
There's so many of these top trends, right? If you really think about it, we're looking at the macroeconomy, right? We're looking at the geopolitical volatility when it comes to tariffs and trade, the impact of AI and where the consumer is. And what we're really seeing is a decoupling of a lot of things that used to, we would say, correlate, kind of work together, is that US GDP is red hot, right? It is fiery hot. It is numbers that people like myself did not anticipate and estimated to get even hotter. But that is happening at the same time that these 2 key aspects we look at in the economy, we call them the dual mandate of the Federal Reserve, inflation and the job market, are both moving in the wrong direction. Now, albeit slowly, but both moving in the wrong direction. So we are seeing a decoupling of top-line economic indicators from actual economic indicators that our consumer feels day to day. And this is something that requires a lot more thought leadership than, frankly, I'm seeing from folks right now. because we can't claim the economy is strong when we are still in what we call this no hire, no fire job market, in that the headline labor market looks okay and not great, but again, okay. And around the mid fours is historically low, and we need to acknowledge that. But we are strongly seeing that companies are not creating jobs. And where this is really happening is our small to medium-sized business. Job growth is flat to negative, and these are typically the engine of the U.S. economy. Now, you put that against inflation. The Federal Reserve likes inflation around 2%. We've been above that for 5 going on 6 years. Now, some people say, well, 3 is the new 2. Well, not really, right? Because consumers are actually really feeling the punch of where that is. And we still have not seen the full impact of tariffs. So we've only really seen anywhere between 20 to 50% of the impact of tariffs come through to the consumer. So when I look at the economy, I look at these other aspects. I take all the headlines, but then I go down to the next 5 pieces of the storyline. We're seeing a no hire, no fire with 2 exceptions, construction and healthcare. Who's losing jobs? Retail, consumer goods, et cetera. And we're seeing an inflation that's not moving higher, which is great news. But there's very little which is going to cause it to come back in the near term. This is making the Fed's job complicated, but it's really actually making a retailer's job complicated, because I'm in this stalemate of my consumer is demanding a lot more value. They're also feeling a lot more of a crunch. And we're going to need to see some shifts in how we react to this.
Yeah, it's a lot to take in for a retail leader who, in many cases, I imagine, and probably worked with many in this mode, who haven't been in this kind of position before, right? They've used to, in the pre-COVID years, they were probably used to a pretty consistent kind of flow year to year, pretty steady and mainstream. And now they're being challenged with these sort of conflicting data points and conflicting movement.
Yes. I often
tell me
the story you want the data to tell, and I'll make the data tell that story, right? If I worked for the administration, I could paint a very rosy picture of how great the economy is. If I was trying to beat the administration in the midterm elections, I could paint a very scary picture about where the economy is going. Now, I don't want any retail leaders to get into politics. That's your personal choice. But we need to deal with the environment we have in front of us, which means being brutally honest about what these indicators are telling us. And more importantly, what that means for our value offering, depending on who our ideal consumer is in this environment.
Yeah, I think a lot of consumers, there's been talk that everybody feels very conflicted, where 2 truths are like 2 opposite truths are true at the same time, where it's like, you feel like it should be going this way, but it's going this way. But, it's very much, just kind of so much more into a loop of, I don't know where we're going, if we're going forward or if we're going backward. I have no clue right now. Everything seems to make sense and not make sense at the exact same time.
And the answer is a little bit of all of the above. And that's where averages are really damaging, right? And, what I'm saying right now, and this is, again, my hypothesis, is we used to, especially in retail and consumer goods, talk about the everyman product. And for those that don't know, this actually came out of kind of political campaigns. You wanted the everyman president, the person that could sit next to you on a bar stool and have a beer with. And it was always a debate in campaigns, who's our everyman president? But we do it in consumer goods. Who's the everyman? And I'm challenging retail leaders that I don't think everyman exists anymore. If you're trying to make a product for this everyman consumer, you're finding yourself in this really messy middle where there really isn't a market there. We are talking a lot about the K-shaped economy, and I'm okay with that. That's what we're in, right? Is that the luxury upper income level, especially for our consumers who are really well invested in the equity market, that spending is incredibly robust and confidence is also pretty high. For our lower income, especially if you have less of your assets in the equity market and you're more reliant on just a basic bank account, the consumer confidence is at historical lows. Like, these things are tanking more than we've seen in previous recessions or wars. And we're seeing reflected in spending patterns as well. But the danger goes back to the data story. If I look at holiday spending numbers, because a little bit of inflation and a little bit because of these averages, I can say, hey, it was the best retail year ever. We're going to say that every single year because of inflation. You really need to dive into that next aspect of where you want to play within this K.
Right. Yeah, it's a bit like whenever I used to see it every year, we see a lot of reports about e-commerce growth as a segment, and the headlines are always about how, it was the best year for e-commerce ever. Well, in my head, this is a little bit of just playing with numbers, because of course it's going to grow.
Exactly.
More people are going to buy. So it would be a real headline if it didn't grow, and versus how much it's growing. And so we can easily get fooled by numbers like that.
Research from Bain and some others suggest a flight to value and slower discretionary spending from consumers in 2026. While grocery, discount, and service formats look stronger, from an SRT perspective, how should retailers decide whether to double down on value, protect margins, or pivot into some of the new formats or assortments, sales channels? There's a lot changing at the moment. A lot of directions to go.
This is one of those, unfortunately, it depends answers, right? So I want to pause on the push to value, because I think it is sometimes interpreted as lower price. Value does not necessarily mean lower price. It means more value for my offering. And this was a really key takeaway from me of the previous holiday period, was consumers were not saying, I want the lowest price. They're saying, I want my dollar to go as far as possible, and I am actually willing to pay more for brands that I value or I have a relationship with, as long as I still feel that value equation is there. And especially in a very difficult economic headwind environment where we're being asked to increase margin, I just always caution retailers, is like, value does not equate to lower price. We have to be very careful when we say that, as I know that you were implying in your question. Look, the general trend is doing well. My favorite stat, I have many favorite stats, so I'll try not to bore your listeners with them, is Dollar General, a retailer here in the US, got 3 million new customers in Q4 of last year. That's crazy, right? But what's more interesting is 60% of these new consumers have an average income of over $100,000 US. So we are really seeing a shift into this, which goes back to that everyman consumer. My retailers in the middle, it's a really messy middle right now. If you don't have a very strong differentiated offering for my luxury consumer, or an incredibly strong value play for my consumer shaping that, I think it's going to be very difficult to compete in the current environment. And what I want to see is very nuanced choices. So experimenting with different formats, really playing with maybe some of the sister brands to find my different consumer. What I'm afraid we will also see is this one size fits all. Well, we're just going to move to a single store format for operational efficiency. That's great if you're at the extremes of the K. That could really hurt you if you're in the middle of the K, because again, that everyman is not there. So my answer, besides it depends, is nuanced choices. And what we really want to see is this testing and iteration, which retail used to lead the game on, right? We used to be the industry that taught others how to experiment and learn for consumers. And we gotten lazy in some ways. There are still leaders, but there is some laziness. And this is why I love uncertainty, because uncertainty is actually the best time to grow for those listening to the call. And they're
Oh, absolutely.
And there's hundreds of reasons for this, right?
Yeah.
The number one reason is that when uncertainty is high, so is honesty. Consumers and customers, partners, suppliers, vendors, employees are never more honest with you about what they really value and what they don't than in times of uncertainty. So for our retailers who want to lean in and say, this is going to be the best growth period we've ever had because we're going to learn faster than we ever have. This is going to be the next exciting cycle they've ever had.
Yeah, I always thought, like, when we came into like the pandemic, it's the most fun train wreck, right? Because it's just the moment where if you were behind but have an incredible product and value proposition and customer base, this is your one opportunity to like leapfrog.
Yes.
Right.
You know,
exactly.
and you can kind of leapfrog against all the junk you've been competing with. Just sometimes it's just sheer volume and money and marketing, because so much retail is pay to play.
Exactly.
And sometimes this is where you can kind of take your kind of like have that X-ray vision to see like, okay, what's really in the market right now? Like what's real versus like what's FOMO.
Exactly.
Yeah.
And
Yeah.
I always like to see that. I think it's It's always a fun because I'm like, if your customer is happy and your product has good value, this is your chance to like get a competitive edge.
Absolutely.
Right. Exactly. Yeah, and I love that you brought up the point that I think we've actually said this, I think, many times on the show too, that value doesn't have to mean price for your consumer. And I'm a big believer as well that it oftentimes doesn't, right? It really does depend. So I think actually it depends in this case is the best answer because it really does depend on who is your customer, who is the target customer for your
let me know if
brand.
you can figure out a way to get 1994 double step Oreos back because these things are ridiculous.
Yeah. Exactly.
My value is 0.
Right. Exactly. Yeah. That's why value is so different to different people and in different segments and product categories. Value can mean something very different. So I do love hearing that part of it about how to find the right value basis for what your customer wants, and then differentiate from there. I think I completely agree with you that especially in that middle segment where just to most consumers, every retailer looks the same because you're selling the same products.
We have very similar strategies. We have very similar offerings. We have, of all the kind of key questions I would say you need to answer in a growth strategy, we have gotten the absolute laziest about what I call our right to win or a competitive advantage. There's many reasons for this, but it's an issue, right? As we tend to do like where to play, these are where I want to play, then I call it playing to win. And I justify my where to play choices by having great brands or great legacy or great partnerships or great people, the same blah, blah nonsense that every single one else has. And the challenge in the retail space is that differentiation does not equal advantage. We have so many wonderful retailers and wonderful brands who have this incredible brand heritage and legacy and manufacturing footprint and partnerships. And these are indeed different and rare. That doesn't mean the consumer of the future finds them advantaged. And so the key thing I really ask people to think about is, am I different or does my differentiation actually provide me advantage? Because if I look at the industries that are changing the most right now, and I work with a lot of, again, the big brands, it's you have to give the message that you could have something which was right to win. And in a strategy cycle, it went from right to win to table stakes to irrelevant to your consumer.
Right.
That it feels like a punch in the gut on a daily basis. But again, you can get better than anyone else at taking the punches and decide how I'm going to learn faster to grow faster in this, or continue to sit on a legacy that your consumer, again, is no longer willing to pay more for.
Right. Yeah. Yeah, exactly. I want to get your view and talk a little bit about stores in particular for retailers, because stores are always, a hot topic of discussion. We seem to go from these pendulum swings of saying that, it's
stores at least 20 years ago. I think I'm not going to speak for anyone else on this call, but I certainly have been through a few cycles of how many times we've called the death of the store. Exactly.
So if I look at what some reports we're seeing, like from real estate analysts or folks like CBRE or talk about, availability and real estate, commercial real estate availability for new stores, because oftentimes we see retailers pursuing that growth just by opening new stores versus any other kind of approach that they might take. And sure, if you open a new store and you increase sales in those surrounding zip codes, that looks like growth.
Yes.
But is it really strategic growth, or is it just this organic growth that because you happen to open a store, have you really, I think maybe to your point about the right to win, have you really won those customers or not? So for retailers that are weighing that kind of expansion versus looking more closely at the productivity and results of their existing stores, what are some of the triggers that you would look at retailers and talk to about that kind of gives them that indication that yes, it's the time to expand more stores versus it's time to pause that and optimize the stores you have?
And I know you weren't posing it as an either or. It's not necessarily an either or. Like we can be optimizing our current footprint as we're looking at new footprints. So it comes back to a couple of things. First, what are your beliefs? A big reason that teams do not agree on strategic choices is they haven't aligned on beliefs. Is they look at the environment, and we have a temptation in classic, what I call operational strategy, to go from trend to implication. So trend, foot traffic down, implication, we need to close stores. Or trend, foot traffic up, implication, we need to open stores. The real sweet spot of a strategy through uncertainty is your beliefs. Actually getting together with your team and saying, well, what's our beliefs? Where does the younger millennial want to shop? Where does the Gen Z want to shop? Where does the Gen Alpha want to shop? How does this differ between our urban and suburban environments, assuming you're a retailer that spans across all of those? This debate is critical across all industries. This week, I was with some of the OEMs having this debate about insourcing software or kind of the move to electric or hybrid or self-driving. And the debates will determine your choices. So first, aligning on your beliefs. And then second, who is your ideal customer? If you are truly competing in that cost leadership space, then single format, incredible efficiency is the way to go. The challenge with the cost leader in the retail space is, as I always say, like everyone else is the loser. I mean, unless you're the winner, you're the loser when you're trying to play that game when you're not set up to win. So if you're a differentiated player, really nuanced, who is your ideal customer? What do they want? What do they look like? And how are we going to win for them? So I actually love to see more experimentation with different formats, smaller footprint, maybe some larger footprint. And look, the trend of omnichannel I know is cliche and old now, but that is what the younger consumer wants to shop when they want, how they want, and they're influenced. Again, you can like it or not, I always say, but it is what it is, right? When it comes to the influence of influencers on kind of the product journey buy. And are you set up that when I am influenced by my influencer, I was just with a big cosmetic brand, so the skin influencer, excuse me, is very top of mind. If the skin influencer influences me, are your brand there and are you available? So I think the key is availability much more than geography, right? So are we available for where they are? But the store is not dead. The retail presence is not dead. We've got a consumer that wants the experience. Again, going back to the value play, value does not mean price. And I want to test this value, one, by having multiple influences into my decision point, but then I might want to actually try this and experience this value myself. And are we available for those consumers that want that?
Yeah, I always say, as all the technology companies are deleting the shopping experience by removing all the friction, I'm like, please remember that there's some of us that actually enjoy shopping.
Yeah.
And that's not friction to a lot, probably half the population.
It's still the part of the experience. Yes, absolutely.
It's the fun part.
Right.
Yes.
Right. Exactly.
Yeah. The final transaction is not for many of us the journey. It's that experience that we're doing around there, and just because we're saying that doesn't mean it needs to be all physical. You can have an incredible shopping experience through VR and AR, different AI tools as well. But again, what are you doing in a nuanced way that matters? There's a bit of consumer tolerance for AI sloppiness right now, but I think that tolerance is relatively short-lived. And so brands have a very short runway, right, to be sloppy and try a bunch of stuff out before they're going to need to figure out the right AI match for their consumers as well.
Yeah. I mean, the consumer is more and more unforgiving.
Yes.
Because there's a lot of, you're no longer brands and their user experience, their customer experience, technology adoption, you're not really competing against a brand when it comes to that customer journey, that customer experience. You are competing with Uber or Pure. I mean, I just bought Pura. It's the best mobile app and customer experience I've ever. I didn't even know the thing connected to Bluetooth. And I'm like, oh my gosh, this is amazing. And I like the whole entire experience. That just kind of rose my bar for everybody else, regardless of what industry you're on. There's a freaking air freshener.
Where I love this is we're speaking about very much consumers, but we have customers as well. And this is a trend that we've been speaking about for a while that's really coming to head. The three of us, if we're used to these frictionless or enjoyable experiences in our consumer life, and yet our business life, engaging with retailers or retail negotiation or shelving is so painful and antiquated and manual and Excel-based, we have much less tolerance for that there as well. We want the same joy in working with these tools to translate. And so retailers need to remember the whole ecosystem needs to embrace these trends, not just the specifics of the consumer journey.
I never understood why B2B software had to be so chunky and ugly and clunky. When as soon as we clock out, we're all using iPhones and love it.
And we want to translate that experience.
We're all consumers.
It makes no sense to me because every single retailer and brand's primary customer base, like ideal customer base, literally are employees.
Incredible testing ground, right? Incredible testing ground. And are we using our employees to be this testing ground?
Yeah. Yeah, exactly.
100% agree.
Exactly. Yeah.
Well, I hope that's something that we're going to see a lot more of. With AI, I'm seeing that user experiences and user interfaces are getting worse, not better.
Yeah.
But it should be very interesting to see how all of this stuff starts shifting, because I think you're 100% right. 100% right.
Yeah, 100%. 100%. So I want to ask you as well, too, about some more operational questions for retailers to understand what they can do. So how should retailers be thinking this year about financing, inventory carrying costs? I mean, their overall pricing strategy, given what you mentioned earlier, the expectations are around, what may happen with inflation, what may happen with interest rates, and so on, that broader economic conditions. What are you recommending to retailers in that area?
No retail strategy should be dependent on the Federal Reserve interest rate policy, right? What are estimates? We have a new Fed chair in place, which is helpful, but doesn't really help us on predictions because we've got so many other influences that come in.
Yeah.
But luckily, I am reassured, right, that the new Fed chair, he has a background, he has a history. He's got a dynamic of working on the Fed, which gives a little bit of assurance to people like myself that not only the Fed independence, but that whole meeting structure will stay. But I have always been a little on the other side. I'm at best pricing in 2 to 3 additional cuts this year. Again, we might get a bit more, but if we get more, it's not going to be for the right reason, right? If we get more, it's going to be because inflation is spiking up again. And in some ways, the Fed has to help the administration help themselves, because we're going to have a lot of stimulus checks hitting in around Q2 with some tech stimulus and potentially some others. We don't want a bunch of money hitting the system at the same time that tariff implications might start passing through. Now, to a retailer, it's going to be like a sugar high, right? There's going to be this small blip of money going into the system. We're going to reassure ourselves that good times are here again to stay, and we're going to get lazy. It's incredible how quickly this industry can get lazy. It is a sugar high, right? It is an insulin spike from too much money in the system for a very short period of time. What happens in Q2 does not negate any of the things that we've just been saying. So long way around to think that I'm assuming the interest rate environment is going to be roughly as it is, but hopefully not spiking back up again. There's very little to indicate that interest rates would need to increase, right? Assuming we roughly have a sense of the economics of the tariff pass-through, even actually regardless of Supreme Court decisions and those other aspects. So financing, I'm assuming it is where it is. You should be making some other plays. I still do like prioritizing that steady flow of cash flow right now. There's just going to be too much volatility in the system to run leaner than you should be doing. Now, in the B2B space, we're seeing what I call continuity trumping cost. And by that, I mean on anything from foundry, so steel, aluminum, input for the large auto manufacturers, there is much more tolerance to pay more over the last year and a half than there has been before, because I need that continuity over cost. So that's the analysis I like to do. Across our supply chain, where does continuity trump cost? And then that's where I'd work for multiple suppliers or more domestic shoring, where actually continuity is not as critical, then continue to source the lower cost items, but be prepared that there might be a pause. So really, again, it has to be almost a case-by-case basis. It's cliche to say that robustness is the way, but that was really what you want. You want, wherever possible, dual or tri suppliers, right, that you can work with. You want as much flexibility as you can. And you really, and this is where AI tools can help. You want to use AI tools to do a lot of supply chain modeling, building what we call this digital twin, to really get a sense of all these different scenarios that might come and play.
Yeah, but I'm glad you mentioned that concept of creating that as a digital twin, because that's another area that I've found gets overlooked a lot. And everyone has been in such a mode in past years of optimizing down to one and feeling like that's the most efficient way to lower costs. But I think I agree with you that it's that it does feel a little cliche to say, right? That you need to be as robust and as agile as possible, but that means going in the other direction in a sense to say you need the variety, right? You need that.
Robustness are not synonyms. They are related, but they are not the same thing. And robustness is your sweet spot, not necessarily efficiency. And the real thing I like to look for is what I call no regret moves. And this is really critical in the supply chain financing conversation, because we sometimes get into such a paralysis that we don't want to make any decisions until we know. And we can actually end up stretching decisions for months, an entire year. And paralysis is really scary when it comes to growth strategy. Now, paralysis is bad because you're moving slower than everyone else. And our industry, by definition, is called fast moving, right? That is actually the acronym that we describe it with. So being slow, not good. And second, paralysis is scary because growth is a muscle. And we seem to forget this sometimes. Growing your team and your organization is a muscle. Performance is a system fit. And if you keep delaying decisions, you actually lose the muscle. And that can really weaken performance over time. So what I ask retail leaders to do is end every strategic meeting with identifying your no regret moves. And a no regret move would say, even if we get our belief wrong, we would not regret making this move. So moving our manufacturing footprint from China to Vietnam, that's a regret move. If tariffs go the other way, we would regret making that move. But vetting additional suppliers, that's a no regret move. Should we need to move quickly, we've already done the vetting. You always have more than you think, and it helps our mindset stay in that growth mindset versus that hunker down one.
I think that's a really good point. I heard, during the pandemic, coming out of the pandemic, still coming out of the pandemic, the wait and see.
Yeah.
What are we still waiting for to see?
Turning to anything. We're not
It's a new world,
exactly.
make new hypotheses, new theories. And there was so much of that. And when you look at like turnover rates in retail, they're not the lowest.
Yeah.
And I think that there is something to be said for like that muscle. It's like every single time you jump, off like the high dive, you go in increments to go higher and higher, and it's easier and easier. And if you just stop for like 2 years and go right to the top to do that, it could be really scary and feel so risky.
And
then if you've been making those changes and flexing that growth muscle, because the more you do, the bigger and bigger and bigger you can go, and it doesn't feel as scary. And we hit this thing where come 2025, we're kind of asking everybody, could you please jump off the cliff? I need you to jump off the cliff because you've done nothing in 24 months.
Yeah.
In the book, you ask leaders to define their right to win.
Yes.
And I love this. I think fabulous question to ask every single person in the room, especially the executives and founders. For a mid-market retailer facing squeezed discretionary spending, what are the practical steps to identify and test a credible right to win?
Yeah. Love this question. It's probably the topic I spend the most time with. And I love this topic. And again, I think it's one that we've gotten relatively lazy about. So right to win, for folks who have been to business school, we spend months on this topic. I always say no one running a company has time for that. And so I like to summarize right to win as just this. It's what does your organization have that others do not? What can your organization do that others cannot? Or how can you build moats around your advantage? And that's your only options. You can have stuff others don't, you can do stuff others can't, or you can build moats around your advantage. And moats sometimes referred to as things like barriers to entry or switching cost or loyalty lock-in. I like the term that many consumer goods companies use of irrational loyalty. I just love this concept of irrational loyalty because you're saying, my brand value proposition is so strong and differentiated. The thought of not getting it gives me so much friction, I can't bear it. And that's irrational
I'm one
loyalty.
of these people with lots of brands.
Yes, I have lots of irrational loyalty.
Exactly. Yeah, absolutely.
Well.
Everyone does.
And so you have to test that. Right to win is like doing an annual physical. You got to lay everything out and challenge every assumption of what do we have that others don't? What can we do that others can't? How can we build moats? And the tests are called the VRI test, for valuable, rare, and difficult or impossible to imitate. And the challenge that many retailers have is they have lots of things that are rare and hard to imitate, but they're no longer valuable. You could say, oh, I have this manufacturing footprint. Cool, like it's super rare, but no one else is stupid enough to build it, right? Because it's losing money. And this, unfortunately, is the challenge with brand. There's lots of brands that are rare and hard to imitate, but consumers are saying, I no longer value this in a way that I'm willing to pay more. So being ruthless and honest, I always say, we're not putting the answer on a billboard. We're not presenting to the board tomorrow. If you're not going to be honest with yourself now, I can't build the right strategy after this. And quickly, this is where AI is really coming into growth strategy, because it used to be I could have a right to win for multiple cycles. Then that timing went down a bit. AI is very quickly competing away resources. It is in the last kind of cycle started competing away capabilities. Where I'll offer as a really great opportunity is it hasn't competed away moats yet. If you as a brand have truly built that differentiated value proposition, that irrational loyalty, an AI solution can't break those moats yet. So that's where I really want people leaning in.
Yeah. The love factor is just Very
So important. Yeah. So important. I love that. So you also describe hard resets, right,
Yes.
for companies that need that fundamental change. So if you have retail that has reached that conclusion, they need a hard reset. What are you telling them are the immediate things they need to consider around people, their portfolio, or capital moves, or things that they should be prioritizing in those first 90 days of how they approach this hard reset?
Well, we're watching them in the retail space right now. So let's talk first about the public ones. Starbucks is going through a hard reset.
Yeah.
Nike is going through a hard reset. Disney needs to go through a hard reset. We'll see whether or not they accept that reality. What I love about Starbucks is he's being very clear, the new CEO, that this is going to be a hard reset. Burberry has been through one and needs to go through a second one. I'll stop naming examples, but there's so many. I'm working with a couple right now. I won't name those yet. Hopefully when it's a successful case study, we'll come back and talk about it. The first thing is going to sound silly, and I'm not a leadership coach, but this point is really important, is you stop and align with the team. When I'm with someone, anyone, could be industrial or retailer, and we realize this will be a hard reset, I just pause. I say, do you want to go on this journey? Because this is not going to be in a couple of months. We're out of this and it's going to feel great again. This could be anywhere from 6 to 12 months, occasionally longer than that. The organization will emerge from the hard reset a different organization, because we're going to potentially reset everything from our beliefs to our right to win, to our top priorities, to our ideal customer. And it's okay to not want to go on that journey. Some folks are at a point in their career where that's not the time for them. And I always say to CEOs, give an out, right? Give an out so the team that's going to be on with you is aligned. Then you don't rush it. You spend as much as you need in the survive phase. I don't want people stuck in survive, but rushing survive is a trap, because also survive is not a strategy. Being operationally efficient, like having great cash flow and a strong balance sheet, is not a strategy. There is nothing strategic about it. It is a basic playbook. I can give it to you right now. There's nothing secret or differentiated about it. So get through that phase. And then the key thing is, when you're in the reset, you need what I call a strategic center of gravity. And you can't start making decisions until you've identified that strategic center of gravity, which is like this crystallizing insight that all of the decisions I'm going to make going forward take. Recent example would be Tesco in the UK, the large grocer there, who went through a hard reset in 2015 to 2018. And their strategic insight was UK and fresh. Again, these are never like groundbreaking. And the notion is, we're competing against little Aldi, Asda. We're the only UK grocer. Why aren't we leading into our UK supply chain, bring a bit more of the British heritage? Advantage them very well, because they started right before Brexit. And the second was fresh. The acknowledgement that we can't win against Asda, Aldi, and Lidl on cost, but we can be cost competitive and more fresh. And so every decision they make when it came to the store layout, the supply chain, the optimization, was through that insight. IBM, very famous one, is, we don't sell mainframes. We sell integrated technology solutions to the world's largest customers. Burberry's strategic insight was, we're going to offer the heritage brand to the emerging market millennial. Check, trench coat, and the check. So I'll just stop with those examples. But if you try to move forward without your center of gravity, your decisions are going to be chaotic. And you've got to wait until you've identified what that center of gravity is.
You're kind of also redefining what your customers in turn defines as their value.
Absolutely.
Right, which again, back to your earlier point, it's not just about price.
It could be new customers, as Burberry moving into emerging market millennials versus the standard kind of woman of the Europe. It could be going back to your existing customers, as Starbucks is trying to do, and say, I'm going to refresh this value proposition that you used to know us and love us for. So there's no right or wrong. What's wrong is moving before you have it.
No, I think there has been, a lot of things where you've been a loyal customer for like 30 years. You kick yourself that you never bought stock for every purchase you made, right? Like every purchase, I should have bought some stock. And then you kind of wake up one morning and you don't even recognize them. And you wonder, like, do you guys even know who you are anymore? Do you know your own brand story?
And unfortunately, we're seeing some retailers in this space right now who are in this messy middle that I've been describing. And it's now or never, right, for some of these brands to figure out where I want to play and what my right to win is going to be, or kindly exit stage left, right, and leave some space for others who do want to make these decisions.
I think that's great. You recommend defining must-win battles to move into the thrive stage.
Yeah, I'm agnostic on what you call them, right? But just have a term. Like we are inundated inside companies with 600 different terms that mean most important thing, from aims and goals, KPIs, OKRs, rocks. I could keep going. I started using the term must win battle. I wanted the punch in the face. Like these are the 4 or 5 things that matter above everything else. Everything else is tinkering. And the key to this, Casey, is differentiated. When I'm looking at a company and your strategic priorities or pillars don't change, in fact, you pride yourself on the fact that they don't change and everyone knows them, that's not a growth strategy. It's what we call an operational strategy. If you want differentiated growth, you must have differentiated priorities, which means your list looks different than other people's lists.
Everybody take note of that. Rewind.
Yeah, I'm going to I want to use that one. Yeah. If you want differentiated growth, differentiated priorities, that's amazing.
You're just dropping the gems today.
I know.
All due to the great questions I'm being asked.
Yeah. No, this has been amazing.
Well, Rebecca, this has just been such an eye-opening discussion. I know that this is going to be just really good conversation, just like coffee shop. I'm going to definitely be sending this recording to a few friends. And I'm like, wait, let's do a virtual coffee afterwards and discuss.
Exactly. Yeah.
Love it. Yeah.
Yeah. This is definitely one of those where I almost wish we had an after show really to let people give immediate feedback on what they're hearing because there's just so much to take away.
So thank you for spending time with us and our audience and sharing Survive, Reset, and Thrive methodology. I am totally ordering this book ASAP and really sharing, how retailers should be thinking about their strategy for 2026. And for some of them, you've kind of defined some pieces in strategy and added a little bit of color that may have been pretty dull from their day-to-day operations of like what strategy meant. I think that there's definitely some great gems in there to look at it a little bit differently.
Yeah, I think it really puts into...
We're lazy.
Exactly. That's exactly it. There's that risk of falling into laziness. And you're right that's a huge trap that blocks you from getting into a growth mode. So I think that's just been fantastic to hear you talk about. So Rebecca, if any of our listeners or viewers of the show want to dig a little deeper into their strategy with you, what's the best way for them to reach out and contact you?
Yeah, so the best way would be to go to just RebeccaHomkes.com or SurviveResetThrive.com. I got a monthly newsletter. I only send it once a month. It's called The Loop. I do a roundup of what's going on in the macro world that matters to you as a leader. I do 3 top headlines that the most CEOs are asking about. I dig into the storyline, then I give you the punchline. So if you're inundated by the news, I'll give you the nuance and cut out the noise. And then I also write a blog every month. So go to either website, sign up for the newsletter, and of course, follow Casey and others, and hopefully buy the book as well. Yeah.
Excellent. Well, we'll be sure to include all of that information in the show notes as well.
Would appreciate that. Thank you.
So with that, Ricardo, it's a wrap.
It is.
Loved this episode? Drop us a 5-star rating and review on Apple Podcasts, Spotify, or Good Pods. Hit that subscribe button so you never miss an update. If you're watching us on YouTube, like and subscribe before you go. I'm Casey Golden.
Follow Retail Razor on LinkedIn, Blue Sky, Threads, and Instagram, and subscribe to our Substack for highlights and bonus content in your inbox. For transcripts and detailed guest info, head to retailrazor.com. The Retail Razor Show is the original show in the Retail Razor Podcast Network. I'm Ricardo Belmar.
Thanks for joining us.
Until next time, stay sharp, stay human, and stay ahead. This is the Retail Razor Show.